Hi, this is Peter Navarro, and in this installment of The China Effect, we're going to look at the economic, political, and strategic dangers posed by sovereign wealth funds. Just what is a sovereign wealth fund? Basically, it's a government-run hedge fund financed by a country's excess foreign reserves. In China's case, it has accumulated over $1 trillion in excess foreign reserves by running huge trade surpluses with the United States. Now, here's a key point. Sovereign wealth funds are neither good nor bad, but governments make them so. For example, Norway is the poster child of a good sovereign wealth fund. Norway's fund, which is fueled by its petrodollars, is totally transparent and is constructively used by Norway's government as a fiscal stabilizer. For example, when oil prices are high, Norway adds to its fund. However, if oil prices fall, Norway can draw down its fund rather than slashing government expenditures on critical needs. And at all times, Norway is trying to maximize its investment return, a key requirement of efficient capital markets. In sharp contrast and in direct contradiction to efficient capital markets, China has a clear historical pattern of strategically using its excess foreign reserves as an economic weapon of unfair trade. A perfect example is China's currency manipulation to boost its exports and create jobs at America's expense. Here's how China's currency manipulation works. To keep its currency pegged to the dollar and undervalued, China first sterilizes its export dollars by issuing bonds to Chinese citizens at high interest rates. China's central bank then maintains the dollar-yuan peg by using these sterilized dollars to buy U.S. bonds at substantially lower interest rates. In this way, China actually loses billions of dollars on its foreign reserve investments. But China is willing to take these losses because it boosts China's exports and creates jobs in the homeland, yes, at America's expense. Now, China also uses its foreign reserves as a political weapon. Whenever pressure builds in the United States to curb China's unfair trade practices, China threatens to dump its vast portfolio of U.S. government bonds. Chinese officials even refer to this as China's financial nuclear strike against America. For such a financial strike would indeed cause interest rates and mortgage rates and inflation to soar and drive the U.S. economy deep into a recessionary spiral. Because China has repeatedly demonstrated its willingness to use its foreign reserves as a strategic weapon, America has much to fear from the growing ability of Chinese sovereign wealth funds to acquire controlling interests in U.S. corporations. One obvious strategic danger is that China may gain control of critical sectors of the U.S. economy, from ports and telecommunications to energy and defense. But here's the big economic danger. Once a Chinese sovereign wealth fund acquires a controlling interest in a U.S. company or buys it outright, the China fund can strip it. It can offshore the American company's jobs to China, along with the company's research and development investment. It can steal a company's managerial best practices. Worst of all, the China fund can strip the American company of its technology, even as it gains access to the company's marketing and distribution channels and customers. Of course, the effect of offshoring jobs in poaching markets will hit America's economy immediately. Just ask Michigan. But over time, moving America's R&D, managerial elite, and technologies to China will also significantly reduce future American productivity and growth prospects. Given these dangers, it's essential that U.S. policymakers adopt a comprehensive set of responses. For starters, the U.S. should demand full transparency for any sovereign wealth fund purchasing U.S. assets. At a minimum, this means quarterly and annual reporting requirements that summarize the fund's financial returns, major holdings, and investment objectives. A second policy option would limit the percentage of equity shares held in any given American company to a level low enough to prevent any sovereign wealth fund from gaining a controlling interest and thereby influencing managerial decisions related to offshoring, R&D, and tech transfer. Third, key strategic sectors of our economy like defense and energy should be totally off limits. Most broadly, we must all recognize that China's sovereign wealth funds only exist because of the massive trade imbalance between the U.S. and China. This trade imbalance, in turn, only exists because of China's currency manipulation and other unfair trade practices. That's why, as part of their response to sovereign wealth funds, it is absolutely critical for the U.S. President and U.S. Congress to pass an omnibus fair trade bill that would put a prompt halt to China's beggar-thy-neighbor policies. With the China Effect, I'm Peter Navarro.